So let's talk about the basics of the stock market to building financial freedom. It's one set of skills to understand the stock market from analyzing companies and looking at charts. And it's a different set of skills to understanding the stock market and building wealth and knowing the basic building blocks to building a portfolio and building that financial freedom. So in this video, I'm going to walk through the 8 basic principles of the stock market that you need to know as a beginner. And then at the end of the video, we're going to put the 8 principles together and walk through how this formulates a portfolio strategy to building long-term success and financial freedom in the stock market. So the first basic principle that we want to understand is the relationship between risk and reward. Every decision that you make in your life comes down to risk and reward. What is the potential upside and what is the risk of me making this decision? When you go to work every single day as an employee, there's a risk return trade-off. The risk is that you'll never get unlimited income potential. You may be stuck at a job that you like or don't like. The reward is that you get some form of security by a paycheck. You get consistency, you know how much money you're gonna make, and you're surrounded by other individuals that are colleagues. You don't have to worry about HR and taxes and all these other things that come with a business. The stock market isn't the only tool to build wealth. It is just a tool to build wealth with certain risk and reward attached to it. The risk that's attached to it is that you may lose money in the market, and the reward is that the stock market can go up, and it can go up in an unlimited fashion. There's no cap to where the stock market can stop. When we're starting out as beginners, we think to ourselves, hey, I'm gonna put this money into the stock market and there's a possibility that I'm gonna lose all of it or it goes to zero. First, you can only lose all of your money if every single stock went to zero. On the other side, if you own an individual share of a stock, let's say of Tesla, you can only lose all of your money if Tesla went bankrupt. So the stock price may fluctuate, but the idea of losing all of your money as a beginner is a bit overstated. As a rule of thumb, when we're looking at this risk to return relationship, the shorter our time horizon, the less risk we want to take. So if you need money next week to buy something, chances are you don't want to put it in high risk stocks. If you have a long-term horizon, let's say 20 years, now you're willing to take more risk because you know that you don't need this money for the next 20 years. So the odds are in your favor of this working out. Our next basic principle is understanding which accounts to use. When we are investing in the stock market, not all accounts are created equal. Different accounts have different characteristics associated that allow us to build wealth. Category 1 is what we call a qualified account, and category 2 is what we call a non-qualified account. A qualified account is an account that has some type of tax benefit associated to it. So the 3 most common type of accounts are a 401k from your employer, an IRA that you set up on your own, an individual retirement account, and then a personal brokerage account. The first 2, the 401k and the IRA, are going to be qualified accounts. These accounts have tax benefits associated with them, but at the same time, they're restrictive on how you can use and access that money. On the other side, we have our personal brokerage account that is the most flexible account, but it has no tax benefits associated to it. If you have a goal that's not associated with retirement, it may not make sense to put all of your money in an IRA or a 401k. If you have a goal that takes you into retirement years over the age 59 and a half, it makes more sense to get the tax benefits associated with a qualified account. Now, I've actually created a guide that goes through all the different account types and how these accounts are used. And I'll put a link in the description where you can download this guide completely for free. Basic principle number 3 is that we need to understand the different types of stocks. You have growth stocks, you have dividend stocks, and then you have special purpose stocks like REITs and BDCs. Now, every company on the stock market has some type of life cycle because companies do not last forever. Blockbuster, Toys R Us, Sears. At one point, these were very successful companies on the stock market. Their business cycle reached their life cycle, and now these companies are gone off of the market. So when we're thinking about growth stocks, These are businesses that have higher upside potential and can grow your portfolio, but at the same time, they haven't reached maturity yet. So they're not going to pay you any type of passive income in the form of dividends. On the other hand, we have our dividend stocks that are more mature companies. They have less growth. So instead, these companies pay dividends, which is a form of passive income that goes to your account. The third set is the special purpose stocks, where we have REITs and BDCs. You're going to see the stock pay higher dividends than what a dividend stock would pay for. These stocks receive special tax benefits from the government, and in turn from those tax benefits, they have to pay all of their net income cash flow from the business out in a form of dividend, 90% of it for them to receive this tax benefit. Basic principle number 4, we want to understand how we make money in stocks. So we talked about some of them, but you're going to make money in stocks from 3 different ways. First way is from the cash flow of the business. The cash flow of the business goes back into the business to grow it and make more cash flows, which grows the stock price and the company overall. Or the cash flow from the business can be paid out in the form of dividends. The third way that you make money from stocks is speculation. This has been extremely popular lately with tech stocks, where the price of the stock is going up. It doesn't necessarily match the performance of the business, but either way, you make money from the stock. Now, there's no right or wrong with each of these, but as a basic investor trying to build financial freedom, we need to understand the different ways we can make money in the stock market so that we can align these expectations to what we want in our portfolio and what our goals are. Basic principle number 5 is understanding the different type of stock market strategies. So the way I like to think of a portfolio is like a box of Legos. When you look at a box of Legos, you have a bunch of different pieces that are all spread out. And on the front of the Lego box is a beautiful picture of what it's supposed to be at the end. Now, we can use these different Legos to create many different things. That they're all the same blocks, but one Lego set may create the Millennium Falcon, while another Lego set using the same blocks may create a Harry Potter house. The stocks in the stock market are like the individual Legos. And when we put all of these stocks together in a portfolio, they create different pictures at the end. There's no one size fits all strategy, but I'll tell you what I used to figure out my initial strategy when I was a beginner in the stock market, just trying to build financial freedom. So I mentioned this book on many videos before, is A Random Walk Down Wall Street. It will tell you exactly what is the best way to begin investing in the stock market. This is the very first book that I read on stock market investing, and it started me off on a really strong path by just understanding the concepts in this book. And one of the concepts in the book is that they break down model portfolios and strategies based on your age so that you can take the Lego pieces and begin to put them together in a fashion that matches a portfolio strategy that works for your age. Basic principle number 6 is understanding market cycles. You need to understand that the market runs in a cycle just like the weather. We call it the peak, the trough, the contraction, and the expansion phase of the market. And during these periods, we have our trough at the bottom right here, and then the market is gonna expand. And at some point, it's gonna hit a top, which is the peak, and then it's gonna hit a contraction period where the market's going down, and then it's gonna hit a trough again, and it's gonna do that over and over and over again. Understanding this cycle is arguably more important than being able to analyze a company. And here's why. You could have the best stock with the best performing company that's doing amazing, and due to the market cycle, the stock price still goes down. After COVID hit, the market just went up like crazy. And during that period, I was doing some individual stock picking. I was still learning the markets, and I picked a bunch of individual stocks that just went up in really fast manner. And I thought to myself, like, man, I'm a genius. I picked all these stocks. I'm a great stock picker. I know how to analyze all these companies. When the reality of it is that everything in the market was just going up because of the market cycle during that period. We were in a really strong bull market and expansionary phase. A resource that I use to understand these market cycles is a great book called Market Cycles by Howard Marks. Howard Marks is one of the smartest minds in the market. He runs his own private investment fund, and he wrote a whole book about this cycle and just understanding how this works in markets time and time again so that you can make the most of it. Because when you're in a trough period in the market, you can invest more aggressively, and vice versa. When you're in a peak period, you can slow down on the type of investments that you're making to better prepare and protect your portfolio. Basic principle number 7 is understanding the emotions and setting yourself up for long-term success in the stock market. You often hear that stock market investing is as much of an emotional game as it is a technical game. So how do you manage your emotions? The first thing you want to do is have a clear game plan and clear-cut goals. Write these goals out, write them on a piece of paper. If you were invested in the market in 2025, the market's seeing a huge drop because of the tariffs, and many investors get scared and they sell out of the market. Well, if you've already written down that you have a 10-year goal in the market to reach X, Y, and Z goal, well, now you know that what's happening in 2025 really has nothing to do with a 10-year goal where you have plenty of time for the market to bounce back. If you didn't write down these goals, it's easy to let the short-term fluctuations of the market begin to drive your decision making and react in an emotional manner. I can't tell you how many investors I've talked to. If you ask them just, what is your long-term goal in the market? They just, well, make money. I mean, I don't know. They don't have a clear set goal and a plan. The only way to be successful long-term in the market is to have a check on your emotional control. It doesn't matter how much money you have. It doesn't matter how long you've been investing, all the information that you know. If you don't have a check on your emotions, it's impossible to be successful in the market because markets are unpredictable. And in the end, we're playing the game of probabilities. We're not playing the game of being sure. We don't know what's going to happen in the future. We're only playing the probabilities. Basic principle number 8 is having a system to manage your portfolio and keep track of everything that's going on. Now, the resource that I like to use is portfoliovisualizer.com. Portfoliovisualizer.com is a free tool. You can upload your portfolio in the tool, and it has a lot of resources for looking at your overall performance, comparing your performance to the S&P 500 or other benchmarks, and then seeing mathematically how much risk you're taking in the portfolio and if this matches. The other tool I like to use is Thinkorswim. You're gonna need a Schwab account to use it, but what Thinkorswim has is a paper trading account where you can test different strategies and concepts without putting actual money on the line. I'll leave a link in the description of where you can access this. So now that you understand the basic building blocks of the stock market, I want you to check out my next video on how I 3x my passive income by using alternative investments in my portfolio.